Hello and welcome to a brand new edition of Marmore's podcast series. We have with us Rakesh, who's an analyst at Marmore. Hi Rakesh.
Hi Prashant, how are you?
I'm good Rakesh, how about you?
Good.
So here we're going to talk about investment banking in the GCC region. Of course, we're going to crunch a lot of data and numbers in the process.
So let's forewarn our viewers that this is going to be a little heavier on the numbers.
Sure.
This edition.
Sure Rakesh. So talking about the investment banking in the GCC region, we know that globally as well as in GCC, the investment banks have been going through turbulent times post the 2007 crisis.
Of course.
And a certain amount of uncertainty still continues to linger in the financial markets.
Yes.
Are we able to foresee signs of revival now?
Well, if you ask me, it appears to have certainly improved if you strictly go with the numbers.
Right.
Let's take the case of the equity capital market.
Mm-hmm.
The underwriting fees from that particular division has actually increased by 23% compared to 2011.
Right.
And if you look at it, the follow-on issues, for example, the rights issues and the bonus issues, they have been the major income source.
Right.
So they contribute around 77% of the equity capital market activity in 2012.
Right. So what we're saying is, talking about follow-ons, we're saying that more number of activities happening with existing companies than new companies.
Yes.
Correct?
Yes. Comparatively, they are much higher.
Right. Can you talk us through some of the IPO numbers in the GCC region?
Okay, I should say the IPO numbers has been a little erratic in the GCC region. Okay, let us take the case of 2012. We have had close to $1.6 billion from 9 issues. And compared to the last year, we had the same 9 issues, but the issues were of smaller size. So the total funds that were raised was $796 million US.
Mm-hmm. So that shows that
so it has been quite erratic.
Exactly.
So for example, 2011 is around half of what was there in 2012.
Sure. But the ticket sizes have increased, is what we get to see.
Exactly.
Yeah. Can you talk us through the corporate debt issues market? We know that it has increased quite significantly in 2012 vis-a-vis 2011.
Yes.
Now, what were the factors that contributed to the increase?
Yes, as you say, the corporate debt sector has performed pretty well when you compare it to the sovereign and the quasi-sovereign issues. Yes, the debt issues from the corporate sector has performed very well when you compare it to the sovereign or the quasi-sovereign issues. You know, in 2009, the total number of the corporate issues was 31. In 2012, it's 45.
Right.
And the total amount that was raised during 2009 was around 13 billion. And in 2012, that's close to 16 billion.
So the ticket sizes have actually reduced, is what we get to see, right? Average ticket size is reduced.
Yes, it has reduced, but the number of issues has increased.
Yeah. So that's a good sign.
Yes. If you look at it, if you ask me the reasons, what were the factors behind the increase, I would say they had quite a strong balance sheets. The low yields, that was pretty much, the company saw them as a very positive sign.
Right.
They will be able to raise funds at a very low cost from the market.
Sure.
And what has happened is there was a lot of caution from the banks before they start to lend.
Right.
So, which actually resulted in these people going to the public market rather than the banks, which was the norm in the GCC.
Yeah, fair enough, because the banks themselves were bitten during the recession, so they had to be cautious.
They had to be very cautious before they lend to corporates and other ones.
Right.
But one thing that is holding back the growth is there is a lack of secondary market for these kind of issues.
Sure.
Only the primary market is available. There is no active secondary market where the conventional debts would be traded.
Yeah, that's a good point, because I think that would be a deterrent for new players coming.
The regulations needs to improve on that particular segment.
Sure, interesting. Now, talking about the loan market, we have seen that the loan market has seen an uptrend in 2012. Now, these seem to be encouraging signs of business, isn't it?
Yes, it is very encouraging. So what has actually caused the growth is, as I previously mentioned, there was a lot of risk aversion among the GCC banks.
Right.
So they focused on restoring the health of their balance sheets.
Sure.
And they also moved away from name-based lending. So what happens in GCC region is your name, the company's brand name speaks a lot.
Right.
So the bank, they cut down on all these things.
Sure.
They started focusing on restoring the health of their own balance sheets and
Right.
coming out of the hit that they took in the 2008-9
Yeah, which is probably the only way out for them, right?
Exactly.
Right.
Okay, if you talk about loan numbers, the volume of loan deals in 2012 is 75 billion US dollars compared to 50 billion in 2011.
Right. Now, talking about the fee structures in ECM, DCM, syndicated loans, and M&A deals, we have seen that they have increased by close to 20% in 2012 vis-a-vis 2011.
Yes.
Now, these are positive signs for the investment banks, isn't it?
Yes, those are very, very positive signs for investment banking sector in the region. But we should also not forget that there are also challenges that needs to be addressed before we can, say that okay, the investment banking prospects are improved in the region.
Sure.
One thing is erratic deal flows, which causes ebbs and flows in the value and volume of the deals. From it changes from month to month. Which in turn results in fluctuation in the fees that is being earned, fees and commission that's being earned from these services.
Sure.
So let us take the case of the IPOs. See, the IPO acted in the GCC region saw a significant jump in 2012, and the total funds raised was around 1.6 billion. We saw it previously.
Right.
But they still lag behind, what we saw during the 2008 levels.
Sure.
So in 2008, we saw close to 11.7 billion US dollars that was raised from the market from 25 issues. So we have not reached that levels again.
Right.
And if you look at the country-wise, what happens is Qatar and UAE, they are moving towards, they are trying to get an emerging market status.
Right.
They're currently in the frontier market status. This is very positive for investment banks because what happens is once they get this particular emerging market status, investors will start to come in because they have to readjust their portfolios.
Right.
So there are going to be a lot of inflows into Qatar and UAE once they get that emerging market status, because those foreign investors, they will try to realign. So all these they track the index. So they have to make the appropriate investments into these countries to be in line with the investments, or there will be a huge difference.
Right.
So we can expect that's a very positive activity.
That's a very interesting piece of information, Rakesh. Now, talking about the IPO market, it is yet to gain momentum in Kuwait, Qatar, Oman, Bahrain. Now, has there been any particular reason for this phenomenon?
See, the initial public offering or the IPO, that depends on a lot of factors. One is the liquidity in the market. Next, is there a need for the company to raise funds from outside? And the availability of other easier source of financing such as bank lending, etc. So I would say the market conditions are mainly to blame for this. For example, in Kuwait we have not had an IPO since 2005. Bahrain, Oman and Qatar, they have not had more than one IPO in the last 4 years. That's a very small number. When you are going to try for getting an emerging market share, that's very low.
Considering the size of the economy in these countries
and how they have grown,
it's nothing. It's nothing. Right?
It's nothing.
Yeah.
So the market conditions, there's nothing that we can do about it. That has been a main factor in deciding the companies going in for an IPO.
Sure. Thanks, Rakesh, for all the insights into investment banking in the GCC region.
Thank you.
That's it from us till the next edition of Marmore's podcast series. Thank you.
Thank you.